Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. We're coming to you from the George Washington University School of Business, Duquesne Hall, Duquesne Family Studio. This is a GW Investment Institute podcast, not investment advice, entertainment, and educational purposes only. All right, so today's podcast, we're going to have an overview of what's going on, a true market check-in of Market News with Rodney Lake style setup, where we're going to go over a little bit of everything because, by the way, there's a ton of stuff going on. Now, this will date the episode, but because things are changing so quickly in the markets, I think it's worth noting time stamping it. So this is March 10th, 2026, and what's the biggest news since one of our last updates? Well, probably that there's a war going on in Iran now. So I think that obviously is something that people are very focused on. And the markets have been up and down in reaction to those things. And so we won't speak specifically about, the updates from the Defense Department. You should watch the news for that. But the market has been reacting in an up and down manner. You've seen oil go over 100, now come back down and, checking in on WTI right now. It's been over $100 and has come back down, and the president has made comments about it. And so, but now you're back down to $84, for example. But it got as high as almost $120 a barrel. And so that's for the, the front month delivery, so they call it. But if you go out further, that has been, had been down already, or had been lower rather. And so that's something that's worth noting. Now, the overall market, so let's do a check-in on, what's kind of the year-to-date numbers on some of these, or some of the, indexes right now. And so if you look at, for example, let's first start with the S&P 500, which is, the biggest index of them all. And so the market has been, up and down in reaction to this. But if you look at, okay, let's do a year-to-date through March 10th. And so it's not quite the first quarter yet here. But, the year-to-date number is kind of flattish almost. It's minus 4.5% here. And so it's, 45 basis points down. So kind of flattish for the year so far. And if you consider all of the up and down, you would say, well, maybe that's not bad. Maybe that's not great. But certainly it's nothing to write home about for return-wise. And so let's check in on the Nasdaq, which is tech-heavy, on the year-to-date numbers there. So if you go to the year-to-date numbers, down actually. And so this is minus 195. So not fantastic year so far for the Nasdaq, slightly better for the S&P 500. And those are the two big indexes that we talk about all the time. Now, some of that has been off of the recent news and what's going on in the markets relative to what's happening in the Middle East and relative to what's specifically happening with Iran. Now, let's check on specifically what's happening today. This is ultra focused, which we don't typically do. And we certainly, remember, don't like talking about short-term type of, gains or losses or anything of that kind, because it can be random. Now, this is in specific mention to what's happening in the Middle East. So again, March 10th here, and today the market is up. And so you had a lot of pressure over the last few days on the downside, and you had a bounce yesterday. You have another bounce today, and the Nasdaq is up 58 basis points, and the S&P is up 39 basis points. So I think the market is really trying to figure out at what level does it stabilize? What level is properly pricing in the risk associated with what's happening in Iran? Now, again, watch the specific news. This is not a Defense Department update, but from what the Defense Department has been saying is that the attacks from the U.S. and having air, primacy, and also the level of attacks coming the other way, we have been increasing from the U.S. side, and it's been decreasing from the Israeli side. So that's something, or it's not the Israeli side, increasing from the U.S. and Israeli side and decreasing from the Iranian side. So if you look at those metrics, it feels like the market's trying to figure out, well, what's happening. Now, obviously, blanket statement here. We're not, promoting any of this and suggesting, that we're, pro-war or anything like that, just to be super clear at the top of the show here. But we're just trying to understand how the market is reacting to this. This is an investment show. Just by the way, that's what I said, watch the Defense Department. But we're just trying to understand what's going on. So we're not, our sympathies go out to the servicemen and women, especially those that have paid the ultimate price, and to the people involved in this conflict. That said, back to the business part is, the market's reaction to all of this has been very uneven, and we're trying to figure out day to day what's happening with respect to that. Now, interest rates seem like they're going to stay, where they are. If you look at what's the prediction for interest rates, they're probably not going to come down. And if you looked at the jobs data, we've had very uneven jobs data. So the recent jobs data is far more negative than people had anticipated, and the prior was far more positive. So you average those out, you get something like, well, probably baseline. And then when we talk about AI, which is a big topic, and we talk about that all the time, but people are trying to figure out, okay, well, is some of this reduction in the jobs market really the fact that people are not hiring because they're replacing people with AI? And I think that continues to be a refrain, at least that's said in the market. Now, is that actually happening? Well, you had one data point that they said. If you listen to Block, they announced, ticker is XYZ. We don't own shares in that company at the Investment Institute in any of our portfolios. We used to. But, they announced actually fairly good earnings, good profitability, but they had 10,000 people, and they said they were going to lay off 40% of their workforce. So about 4,000 people. So that's quite a lot of people relative, obviously, to the setup. Not a lot of people relative to the overall job market. But if you look at a specific company that says, they said specifically that AI was effectively going to replace that work, and they were looking to use more tools to promote that even further, their AI and AI forward. And I encourage you to check it out. Now, whether that's exactly the case or not, or it was convenient to do that, or maybe they had too many people to start with, right? Jack Dorsey runs Block. Maybe they just had too many people at the 10,000, and this was a way to do it, or this was a way to rationalize it. I don't talk to Jack Dorsey on the regular, so I don't know what's in his mind about this, anything more that's publicly available. So, we'll take it for what's in the public market there, that at least I think this creates pressure. So when you look at the jobs data and you factor in a data point like that, or you at least think about that, that's a challenge. Now, on the other side of that, you're seeing that places like Anthropic are hiring, more software engineers, as an example. So does it mean that the nature and the distribution of those jobs are going to change? Very likely. The AI will influence that. How does that happen, and over what time period? I think it's very challenging to tell, but you can definitely see, and again, we've talked about this on other episodes, that the companies that are playing to win in the AI game, deploying lots of capital, remember thinking about Alphabet and Amazon and Microsoft, Nvidia, of course, and Tesla. So you're looking at these companies that are deploying real-world AI in some cases, and certainly on the software side. And then you have the frontier models like ChatGPT, Grok, Gemini, and Anthropic's Claude model. Who's going to dominate? Certainly there's a mix now, trying to understand how the market plays out. Now, how does that is translating into the overall market? Some of the companies that have been under a lot of pressure are companies like Salesforce, and you've had Mark Benioff on saying that he's seen this before, the SaaS apocalypse that keeps coming, that's never come. But there is pressure on those companies. There's pressure on companies like Salesforce, like Adobe, for example, and Adobe has been hit pretty hard. So how are companies like that, and we own some of these companies, and I think we have to really think through how that's going to work. And what's the end game for all of that? Are they going to incorporate it more? Is it going to be really displace them? I think that's the challenging part. As an investor, business person, and analyst, I think it's very challenging for us to really think that completely through and not really have, it's really, I think unclear at this point, what's that going to look like? Because you can't just play it forward, or at least I don't think so. You can't just play it forward and say, well, look, this is where they are. This is what's going to happen to them. These companies, if they have good management teams, which many of them do, the software companies, they're not going to just stand still. They're not going to do nothing about it. They can reposition. And I think one of the things, and we've mentioned this likely before in other episodes, one thing that is, I think, consistently underestimated is the impact of a high-quality management team on a business. and a business that's changing rapidly. So I think as a business person, analyst, investor, you should all be thinking about, and I'm thinking about, well, what are the management teams that we should be really looking at and thinking about, well, how are they going to reposition this company? Now, for example, when we talk about Apple, and certainly I've talked about Apple being slow in the game of AI. Well, and we'll mention a little bit of Apple news as well here. Maybe, it's been the right position that they have waited. They have not spent all this money building their own AI frontier model and building out data centers and otherwise. And they've set back, and now they're partnering with Gemini, and that's the way to do it. They keep their customer base, they keep their services revenue, they keep their ecosystem going. They released the iPhone 17, which I have, and it's done better than expected. And it was difficult even until recently to anticipate how well that's been working as far as the iPhone 17 turned out. And we don't necessarily know now, but maybe this is a viable strategy for them from here forward to include AI in their ecosystem. Now, they've recently released some additional hardware. So you got the upgraded M5 chips, and now you have this MacBook Neo, which is a fairly interesting sort of the low-cost entry model, $599, maybe coming after some of the Chromebooks. So I think that's interesting to watch for Apple. But they've definitely taken a different strategy than I would say some of their Mag 7 peers. Now, talking about Mag 7, it would hard to have an episode of Market News with Rodney Lake General without talking about our top holding, again, not investment advice, which is Nvidia. And Nvidia still looks like it's in the driver's seat. Now, Nvidia's share price has been all over the place. And, they announced earnings and people thought, well, maybe they should have been better. But they're still very good. So, and if you look at Nvidia, again, it's March 10th. It's at 185. And what's the year to date here? It's down 56 basis points, 0.56% here, a dollar, basically, a little more than a dollar. And so, but if you look at the 1 year number, it still remains quite positive, up 73%. And if you look at what's the PE ratio for this, the forward PE ratio is in the 20s. And so it's hard to look at Nvidia and say like, well, the forward PE ratio on Nvidia and the forward PE ratio on the market it's only slightly more expensive Nvidia. So the quality of the business is not that much better than the average business in the S&P 500. I think it's very challenging to say that. Now, there are lots of risks associated with trying to understand where Nvidia is going to be in 5 years, much less 10 years, but let's say 5 years. And the market cap's already $4.5 trillion. So it's already a very large company. And so to double from here, you go to a market cap of nearly 10 trillion. Now, one of the things that Jensen Huang has said, who's CEO, and I think fantastic CEO overall, but fantastic CEO for Nvidia, and specifically here, is that people need to get rid of this idea of how big companies can get. And I agree with that. And I think this is something that people need to put aside to say, well, you hear this saying that trees don't grow to the sky, but it doesn't mean that we just, maybe if you haven't seen a really big tree, if you haven't seen a sequoia before, redwood, maybe, the idea, that, you've only seen maple trees, you've never seen a sequoia will really throw you off as far as like how big a tree can get. And so I do think, and maybe that's not a great analogy, but in any case, the whole point is, and by the way, these companies are not limited by this, physical nature either. They can get even bigger. And, you could say, as long as the economy continues to grow, and certainly as you grow around a few vectors, and which I'll mention, if you're growing on the energy front, which you need to supply all of these things, you're growing on the AI front, which you need to drive all of this. And certainly that's the business that NVIDIA is in and the business that a lot of these companies are in. And I think the other vector to think about, and we've talked about it on the show, but I'm going to bring it back, is the space industry and the data centers in space. And I think you really get to a position where you're driving a level of compute that's possible at a scale that we haven't thought of, which could then drive GDP way higher, especially when you include as part of the AI, the real world piece. And so if you're thinking about the vectors, energy, and so if you get lots more solar on the terrestrial here, on the ground, plus you have solar in space for the data centers. So you're getting towards sort of, several orders of magnitude increase in the energy production, and then associated with AI, which is that second piece, or depending on what if you want to put first or second, then you included in that AI piece is that real world piece. If you include robotics in that, when you start driving robotics, then you're not GDP per capita, right? You're no longer bound by that because you have lots of robotics. So then when you talk about, well, how big can some of these companies get? Well, they're not really bound by the same metrics that we traditionally used to think of GDP and the nation and the size of an economy based on the number of people in this per capita setup, because really you have AI plus robotics and then you incorporate the energy, and then you incorporate a different place where you can really access, we can call it unlimited, but vast amounts of energy, and certainly much higher than we're used to in space 24/7, 365 when you have solar in space. The GDP numbers can be way bigger. And so that was a long way to say that Nvidia could easily be a $10 trillion company. Nvidia could easily be a $20 trillion company if you start to make progress on some of those metrics towards building an economy that relies on really abundant energy and very low cost, AI, both software and real world, and this idea that you can get some of that done in low Earth orbit and possibly beyond. SpaceX is talking about moving their sort of center of gravity, so to speak, towards the moon rather than Mars to build a base on the moon. And so you could certainly launch things from the moon into Earth's orbit far easier than you can do it from Earth as far as the gravity and what it takes to get something into orbit. So things will change, and I think that's something that we have to think about. Now, the rate of change and the pace of change and how those things are done, I think it's difficult to know. But I do think if you start thinking on those three terms, think about, as a business person, investor, and analyst, think about energy, think about AI, and think about the space industry. And I think if you think in these terms, it can also help provide context around where the market is going and where some of these companies are going. So, for example, back to NVIDIA's chips are going to be in these data centers in space, right? So if they're hardening their chips, and we already have lots of satellites in orbit doing all sorts of things. So the idea that, you can't do that, I think is it's already been done. Now, specific to the GPUs, there's already been one tested for sure for NVIDIA. But I think you have to harden those chips against radiation and degradation. And obviously you can't service those things easily. And so you have to really, or maybe not at all. So you have to really think about that. And I think that changes a little bit of the dynamic. However, when you think along these three vectors, again, energy, AI, space industry, I think your concept of how big the economy can get changes. And then when you say, well, how do some of these companies fit into that? Well, these companies can be much larger than they are now. So again, NVIDIA today, $4.5 trillion. Could NVIDIA be 10 trillion, 20 trillion? I think so. Especially as you start to unlock those categories and you get lower cost deployment to space, which again gives you access to this giant fusion reactor in the sky called the sun. But that's also, you can also put panels on Earth to collect those. They get more efficient. Excuse me. So I do think that this concept of being limited by prior thinking, I think is something that you have to really consider and also try to manage yourself. Excuse me. Taking a sip of water here. All right, so back to the overall market. So where are we? Obviously it's been up and down for the year, and I think it's been very challenging given, excuse me, all the things that have been happening year to date. And so if you really think through all the challenges that we've had, all the uncertainty, and people love to say, well, the markets are uncertain. They're always uncertain, by the way. That is the nature of the markets. I think they're doing relatively okay. And if you look at the fundamentals for the economy, they seem to be relatively okay. Now, we do need to stay tuned for what's happening on the jobs data. I do think you got to pay close attention to how AI is impacting that jobs data and how that's going to flow through in the market over the next couple months, over the next couple years. So I think it's super important for us to keep that front of mind, keep that at the center of what we're doing. Certainly for our students who are on spring break right now, Our stock pitches will be coming up here at the end of the semester for our Phillips Fund. We're going to see the models for the quant fund, so we're super excited about that. But there's so much happening. It's an exciting time to be following the markets, an exciting time to be in the market, certainly an exciting time to be learning about the markets. I always encourage our students, this is a great time with AI happening. It's a jump ball. Go out there, learn as much as you can about what's happening with AI, how you can apply that to the investment world, how you can better understand these companies. So it's a super exciting time to be in the market, be thinking about the market, being an investor, being a learner, and being an analyst. So I encourage all of you to do the same thing. And with that, that'll wrap this episode of Market News with Rodney Lake, and we'll see you back on the next one. Thank you. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.